Welcome to the channel. Here, we provide clear, actionable insights into the complex world of tax and accounting to help your business thrive.
Welcome to The Explainer. Today, we're skipping the high-level theory and jumping right into the nitty-gritty. We're talking about the critical, technical differences in how financial statements are presented under US GAAP versus IFRS. And trust me, these aren't just cosmetic changes. They can totally change the story a company's financials are telling, which is, absolutely crucial if you're doing any kind of cross-border analysis.
So here's our game plan. We're going to start with liability classification. A small detail, you might think, but it has massive implications for how liquid a company looks. Then we'll hit the income statement, look at some core requirements for the entire financial package, and wrap it all up with a few specific but super important details in cash flow and deferred tax accounting.
All right, first up, liability classification. This is probably one of the biggest presentation differences out there because it hits a company's liquidity ratios right where it hurts. And it all comes down to one thing really, timing. As you're about to see, the two standards are practically on different planets here.
Okay, let's paint a picture with a super common scenario. Imagine a company has a short-term loan on its books. Their year-end is December 31st. Then, in January, before the ink is even dry on the year-end reports, they manage to refinance that loan into a long-term one. So, the big question is, how do they classify it?
This is where it gets really interesting. Look at the difference in that cutoff date. Under US GAAP, you get to look at events that happen after the year end, all the way up until you issue the financials. So, in our example, that loan, boom, it becomes non-current. But under IFRS, that window slams shut right at the balance sheet date. The refinancing happened after December 31st, so for classification purposes, it might as well have not happened. That debt has to be classified as current.
So here's the key takeaway on this point. IFRS is way stricter. It says the company must have the unconditional right to put off payment for at least a year, and that right has to exist on the reporting date itself. This pretty often means a lot more debt gets labeled as current under IFRS, which can make an identical company reporting under US GAAP look a whole lot weaker from a liquidity standpoint.
Okay, so let's up the ante. This timing thing gets even more serious when you start talking about debt covenant violations. So imagine a company technically trips a loan covenant on December 31st. But they're on the ball, they get a waiver from their bank on January 5th. Again, how do we classify that debt?
And would you look at that? It's the exact same pattern playing out. US GAAP gives you this sort of grace period. Since the waiver came in before the statements were issued, you can still classify the debt as non-current. IFRS, it's absolute. If that waiver wasn't signed, sealed, and delivered on December 31st, that debt is current, full stop. It's just a perfect example of these two different philosophies on timing.
All right, let's switch gears and head over to the income statement. This is another area where the standards go their separate ways on a really fundamental choice. How do you present your expenses? This isn't just about making things look pretty. It's about whether you tell your performance story based on an expense's function or its nature.
So if you're an SEC filer under US GAAP, you don't get a choice. You have to classify your expenses by their function. Things like cost of goods sold or SG&A. IFRS, on the other hand, is a bit more flexible. It gives companies a choice. You can present by function, just like in GAAP, or you can present by the nature of the expense, grouping all your salaries together, all your rent, all your depreciation, and so on. But there is a little catch. If an IFRS company does choose the function method, they still have to disclose the expenses by nature in the footnotes.
Okay, let's zoom out from the line items for a minute and look at the big picture. There are some really key differences in what's even considered a complete set of financial statements and how much history a company has to show. Let's break down these 3 points. First up, the statement of changes in equity. Under IFRS, it gets its own spotlight as a primary statement. Under US GAAP, it can often be tucked away in the notes. Then you've got comparatives. IFRS is simple, one prior period across the board. The SEC rules for US GAAP filers are a little more complicated. You need 2 years for the balance sheet, but 3 years for things like the income statement. And finally, this is a really interesting one. IFRS has this unique third balance sheet rule. If a company goes back and changes an accounting policy, they have to present an opening balance sheet for the earliest period they're showing, which gives you a much clearer starting point for your analysis.
All right, let's wrap this up by zooming in on two very specific but really important technical differences. One pops up in the cash flow statement and the other in deferred tax accounting.
Let's talk restricted cash, money that's been set aside for a specific purpose. US GAAP is crystal clear on this. Any changes in your restricted cash have to be included right there in the statement of cash flows. IFRS, though, is pretty quiet about it.
Its guidance really only talks about cash and cash equivalents, which means you can see a lot of different presentations for restricted cash. And as you can imagine, that's a huge headache for analysts trying to compare companies.
Okay, now for a more complex topic, and this one is exclusive to IFRS. It's a concept called backward tracing for changes in deferred taxes. The core idea is actually pretty simple. Wherever the original item went, that's where its tax effect has to go too. It follows it around.
So let's walk through it. Let's say a transaction creates a deferred tax asset, and it's originally recorded in Other Comprehensive Income, or OCI. Sometime later, the government changes the corporate tax rate. Now, under US GAAP, the adjustment for that rate change would almost always just flow right through the regular income statement, the P&L. But under IFRS, you have to trace it back. Since the original item landed in OCI, the tax adjustment has to go to OCI as well. And what that does is it can dramatically reduce the volatility you see in a company's earnings compared to GAAP.
So, at the end of the day, what does this all mean? The big takeaway is that these technical presentation rules matter a lot. You can have two companies with the exact same operations, the exact same transactions, but they can end up with financial statements that tell completely different stories about their liquidity, their performance, and their earnings volatility, all because of the accounting standards they follow.
So I'll leave you with this question to think about. Next time you're looking at global competitors, how might these differences, classifying a loan differently, or recognizing a tax adjustment in a different place, totally distort your ratios and your conclusions? Being aware of these rules isn't just some academic exercise. It is absolutely essential if you want to do accurate, insightful, global financial analysis.